Okay, so this is actually just for me to show you guys what I did today. And this is a framework of how dons or how I trade. So let's just get straight into it, right? So this is today. These are a couple of screenshots I took on my phone because I normally access the trading charts on my phone, and I normally execute my trades on MetaTrader 5 on my phone. So yeah, this is what I did today. So this is on gold. So as you can see, I will probably explain what you need to do, and I'll probably give you like how I trade and how I look for setups and how I look for certain things in a separate video. I just want to explain to you what I did today, because I think a lot of the times we just use the word trading and stuff, and no one actually seems to explain to people how they trade, what they do, and just simply showing a chart and showing their positions, their stop loss, the the targets that they do. And they don't normally show you that. In fact, most people don't. They just show you a lifestyle, they just show you the end products, they just show you that it is very lucrative to be in this industry and to just be trading in general, but they don't actually show you what they do and why they do it. So I'm gonna do that in this video, and I'll probably give you like a blueprint of how I aim to get these setups in a separate video, because I don't want to make these things long. So this is one screenshot I took today. I think it was around, as you can see, the time is up there. So this was today, as you can see from down here, the 21st of November. It's on a 5-minute chart. So I saw something on a 1-minute chart, and like I said, I'll explain the technicalities in another video, but let me just go through the trading part, or like the execution part. So I aim for a 1:3. So I risk 1 and I make 3, right? 1:3. So in this case, I was risking $2 to make $6. And there were 3 positions, I think, on this trade. I think maybe there were 4. Maybe there were 3 or 4. But multiply, I think there were 3 positions. How could I not remember, man? I'm the one who actually put this in the market. There were 3 positions. So multiply 2 by 3, and then multiply 3 by 6. So in this case, I was probably risking, you know, $6 to make $18. Yeah, so that's how much I was risking on this trade. I don't want to really use money a lot, but I just want to fixate your mind on the risk to reward ratio. So the risk is obviously 1, and then the reward is 3. So 1:3. So this is the price that I had entered. I entered around 1989 level, and I like to put my stop loss. As you can see, the stop loss is right there. I like to put the stop loss just like 20 pips, or about $2, like I said, because 1:3. So I want it to be about $2 or 20 pips, like below, you know where below where I entered. Obviously, it's much easier to figure that out on this asset gold, because literally 1993 to like 1993 30, 1993 38 to like 1994 38, that's like $1 worth of movement on this asset. Obviously, you have to figure out what that is on other assets you trade, but obviously I was trading gold. So as you can see, the price started to move in my direction, and what happened, right? In fact, yeah, what happened is that it moved up again. So what happens, as you can see, the stop loss that was once over here, I moved it up there, and you can see that was probably about like 6 or 5 minutes later. Sorry, as you can see, I took this photo 5 minutes later. From this photo, I moved my stop loss to break even now. So what happens now is that if the price, or if the live market price, had to come back to this area, this 1989 area, it would take me out. These 3 positions would close at 1989.96. That's what price it would close if the price had to reverse. So I normally move the stop loss. I normally modify, as it's called on MetaTrader. I normally modify, or I move the stop loss if the price moves 20 pips or $2 away from the price at which I had entered. So obviously that's 1991 and that's 1989. So 90, 91, that's $2 of movement. So then I would move the stop loss to break even. So then now I have zero risk basically. So if it came back and had to come back in this area, it would take me out the market, but it won't take me out at a loss or a profit. It would just take me out at zero, break even. So then what happened is that the price actually continued to go up. It didn't go down. So what happened? It moved up $2 again. So what did I do? I moved the stop loss from where it was over here at 1989.96. I moved it now to 1991.74. So I moved it up. And from the point where it was $2, so about, let's say 93, because as you can see, this candle is quite long, so it moved really quickly. So like when I'm actually going to the positions and modifying the stop loss, obviously the price is moving as I'm doing that, because it's a live market, obviously, as you know. It's not going to be picture perfect 1993. It's obviously, it looks like it's $3 more than that, but anyway, like I said, it's live. So next one, right? It carried on going up. It didn't go down. It just carried on. It now went to 95. So from 93, it moved $2 again. So what do? I moved it from 1991.74 to 1993.74. Do you see that? So it's literally just $2 increments every time the price goes up in my direction. That's how I manage trades. That's how I do it. There's two things to trading. It's the analyzing part, and then when you've executed the trade, it's the managing. This is how I managed it. I hope you guys can actually see this, how I managed this trade. I moved the stop loss from around the 87 level to break even to 91, now to 93, because the price just continued going up and up and up and up and up and up. And again, if the price now goes from 95 to 93 and hits the stop loss here, it will take me out of the market at about 90, 91, 92, 93, about a $4 movement away from this where I had entered. And these positions obviously that I entered, you can see it says buy. So it would have taken me out of the market in a profit, because the price is obviously above 1989. It's at 1995. Duh. Anyway, so instead, it continued. It did not even go back to 95. It absolutely skyrocketed to my take profit level, which obviously what I said, it's a 1:3. So I was risking $2 to make $6. So in this trade, I think I was risking $6 to make $18. So it already hit my take profit level, which was 1997. It smashed all the way through. It went to 1998. So that was a successful trade. That was a successful trade today. I took this today at around, 3:07, and now I closed it at around 3:30. So literally it's like 23 minutes, or 20. My math is off, but you get the whole point. It's not always going to be 20 minutes, because this is on a 5-minute time frame. I executed that on a 1-minute time frame. So obviously it depends on what time frame you guys are trading, but hopefully you guys can understand now. I've just took you step by step what is happening. So let's go back, because this is actually what I aim to do. I went all the way back here. So enter the position. Stop loss is $2 below where I entered. And as the market goes in my direction, if it goes in the direction, and look, if it literally goes to 90 and goes down all the way to 87 and takes me out, then -1 on that trade. I lost that trade. That's part of the game. It just so happened that I won this trade. I was successful in this trade. It's not luck. That's actually something that I'm going to talk about in a separate video. So as you can see, stop loss is there. I entered there, and as it moved $2 away from 1989, I modified the stop loss so then I could, cut the risk. So now I won't, lose this trade if it swings, because it could happen where the price could swing and it could never go back to 1989. So that's why risk management and stop losses are so important. And again, it moved up $2 again. I moved the stop loss. It moved up $2 again, moved the stop loss, and until it hits my take profits. And again, you might be in a situation where that the trend, and it actually, I'll show you further on in the video, the price actually carried on going up and up and up and up. And you probably are gonna say to me, well, Dons, you could have stayed in the trade, you could have just milked it, you know. But that is the beautiful thing about having rules, guys. Your rules are there to make you money. Trading is not gonna make you money. Rules are, okay? Let me say that again. Trading is not going to make you money. Following rules is going to make you money. That is what's going to make you profitable long term. It's not trading, it's having rules, sticking to those rules, and you will see a consistent results instead of having random results where you have no system and you have no rules. That's my system. I don't care if the price can continue going up. It did. It went all the way to 2005. But those are my rules, you know. And can I just show you something else? I took some screenshots, you know. These are screenshots of some signal providers because I always like looking at signal providers on like Telegram, and like they pop out of nowhere, right? But when this was happening, right, when all of this price action was happening, like I want you to look at the price, you know, at around 3:30, right? This was at 1998 at that time. And I want you to actually look at the signals they gave out. So obviously the signals are just telling you where you should buy and what asset you should trade. So obviously they're giving signals on gold, you know, the same assets, you know, as you could see that I traded today. Same assets, they were giving gold signals to sell, right? Gold sell now. Let's go sell. Please stay alert. Sell gold at 1991 and at 1995. So between this price range, you know, same thing. Sell gold between this price range. Sell gold between this price range. And look at their stop loss. The stop loss was 1997. The stop loss of a year was 1998. The stop loss of a year was 1997. And look where the price went to. 1998. They got stopped out. They got liquidated. And all they and all relatively 1991, 1995, 1992, 1993. So let's just say roughly about 19 let's just say roughly about 1991, right? To about 1995, right? That's basically what they said. So around here, they are saying to you that you should sell in this area over here. This area over here. Well, maybe I should just do this actually. They are saying to you that you should sell in this area over here. And I exactly know why they said you should sell in this area. I know why, right? It's because if you looked at the price, right, and this happens a lot, if you look at, can you see why it would force retail traders and it would force certain people to look for shorts instead of actually understanding trend, instead of actually understanding where money wants to go, instead of actually understanding that just because it broke down for 3 hours or for 3 days or for 3 weeks, because that will happen in a market, it doesn't mean that it is time to sell. Just because, you know, and vice versa. So in this case, obviously it's the market went down, and it could be the opposite, right? Like I said, vice versa. They were looking, every single person's auntie, mother, father, their father's dog, the dog's, you know, cubs, the cat's friends, mouse, every single person on the planet was probably looking to sell in this imbalance over here. That's an institutional term. I know some of you guys don't know imbalances, but it's okay. Some people will probably be looking to sell in the supply zone over here, this last upward movement before that downward candle. Some people were looking at this as some sort of area to short, and people were probably looking to sell over here already. You know, you could see the price came here, it went down. You know, it came here, it went down a little bit. It came here again, it went down a little bit. It just wicked and it came down a bit. This is creating a big cloud, and this is not my term, this is MintFX's term. Shout out to MintFX. This is creating a big cloud of liquidity, guys. This is exactly how liquidity is engineered in a market is because now people are shorting and they are looking to get involved in areas where they shouldn't be getting involved, and they are ultimately going to find themselves on the wrong side of the trend. And that's exactly how trends sustain themselves. It's because people still think of buying low and selling high when markets don't really function like that. What you should be doing is you should be finding a context, you should be finding a higher time frame model that fits that context, and you should go on a lower time frame and confirm that context with the higher time frame context, so then you can get a overall context of where price wants to go, because this is exactly why this happens over and over and over and over and over and over again. People get stopped out, they get liquidated, they do not understand that's not how markets move. So that is exactly why I showed you those pictures over there where I showed you sell, 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 because they're all looking to sell. And you saw the price literally just went through it. Absolutely went through it all the way to 1998. And guess what, guys? So this is actually, I'll explain this now, but guess what happened? I think, in fact, I probably need to explain this. So now the price is around 2000 level. That's $2,000 now. So I saw the same thing, right? I took the trades again. I didn't actually take a lot of photos for this because I think I went out at this point in time, so I wasn't really on my phone like when I was at home when I was taking those other trades over here. But same thing, right? 1999, 2000, 2001. As you can see, I put the stop loss over there, you know, because I move it by $2 increments. That's my system. And obviously, my system will evolve over time as markets evolve. And obviously, my stop loss probably would have been around 1997 at the beginning. And as the price moved in my direction, I would obviously modify that stop loss. And I think this one actually stopped me out. If I actually go forward, I think this one, yeah, I think it actually stopped me out at around 2003 because it did go to about 2005, and the price actually came back and it actually took me out the market. So it took me out the market about 2003. So 2000, 2001, 2002, 2003. So again, $4. Well, not again, because actually that one I actually won the trade. But this trade, I didn't actually reach my full 1:3. I actually only reached about $4 worth of movement of it. And I think I probably also entered 4 trades in this. So I probably made, how much did I make on this trade? You figure that out. I probably made $16 on this one. Yeah, 16. God, my math is so bad. 4 times 4 is 16. Yeah. So this one didn't go all the way. So if I actually had kept the 1:3, I was probably risking $8 to make $24 because I actually had 4 positions open on this time, and then that other time I had 3 positions open. And also the lot sizes matter. You could actually see my lot sizes are probably like 0.01. So obviously it depends what lot size you're trading. It will also depend on the movement of, the amount of, money you would make on the trade. I don't want to use the word money because I actually want to speak more about the skill rather than the money part. But let me go back to that. Since I've explained that it went all the way to 2005, guys, guess what? You wouldn't believe it. So these were the sell signals they gave at around 3:30. You can see. In fact, not 3:30, sorry. That's just when I took the screenshots. So this one was at 3:12. This one was around 3:15. This was around 3:11. So between 10 past and 3:15, they all gave the same signals, and those were the trades that you were supposed to take at that time over there, as you could see, right? So later on at around 10 past 4, right? So you can see 5 past 4, 10 past 4. The other guy didn't give a signal, so I only got these two. They are still looking to sell, which is absolutely ridiculous in my opinion. They are looking to sell. And guess what happens, guys? Look at the stop loss. The stop loss is 2005. The stop loss is 2004. That's the stop loss that they are suggesting to they subscribers 39,305 subscribers to do. This person is suggesting to 43,000 people to put the stop loss at 2004, dollars level at gold, the same asset, right? Gold. They're trading the same asset, right? In fact, I wish I could show you that screenshot. And like I said, this was around 1644. There was no indication whatsoever that the price was going to reverse. Each and every single person probably saw, again, this would have happened. They saw this area right here when it went down over here. I know I have the thing in red, but hopefully you can see what I'm talking about. Actually, let me just change the color. Like they probably saw, let's make it like to yellow. They saw this movement down, right? This whole thing down. And now they think it's time to sell, right? Again, guys, they think it's time to sell. They're looking to sell over here. They're looking to sell over here. They're looking at this. They're looking at this imbalance over here. Again, I know you guys don't know what an imbalance is, but it's not really important to know. But they're looking at that stuff and they are looking to sell. And again, look what happened to the price, or what happened to the price? Absolutely just continued. Didn't go down whatsoever. Yeah, you could see these little movements down over here, these red candles over here, that is creating a sentiment to make people believe that it's time to go short when you are in a bullish market. You are not in a market that is showing you that it wants to go short. And again, like I said before, which is a MintFX terminology, not my terminology, you are creating a big cloud of liquidity. Again, which is exactly why price continued all the way to 2005. Look, 2005. And where was their stop loss? 2005. 2004. So he got stopped out. He definitely got stopped out. He got stopped out twice. He gave two sell signals. He gave another sell signal. That other guy probably gave a sell signal in his VIP group, and all their subscribers probably all got stopped out. They probably all got stopped out because they do not understand trends. And this is not for me to shit on people, by the way, guys. Look, these guys probably must be making more money than me. That's not the point. The point is people don't actually understand how markets move. There is an underlying reason why markets move the way they do. There is a reason why it will go to a certain place, and people need to understand that you cannot assume that you cannot think that a market is now going to reverse just because it did a 1 hour breakdown and there was a huge bearish engulfing candle or some retail terminology. I don't know what people use, right? You cannot just assume that, guys. You need to understand that a market doesn't reverse overnight. Millions and millions and billions and trillions of dollars that enter the market every single day doesn't just reverse all of a sudden. It takes time for trends to run out. And even if on lower time frames, it looks like the trends run out much quicker because obviously it's a lower time frame. But you need to understand context. And in order for you to understand context, you need to actually look at charts. You actually need to do things. And actually, that's probably one thing I'll actually explain to you on another video. But you actually need to, you really need to understand context about a market. All markets, they all move in a certain way. They all behave like this. They all accumulate. They all distribute. They all go through markup and markdown phases. They all do this. So to think that you have a 1 hour candle where it broke down, or 3 days where it broke down, or a week where it broke down, it's time for you to sell, or it's time for you to buy if the trend is a bearish trend. No, because that's how true liquidity is engineered, and that's how people get stopped out, and that's how people actually lose money in trading. You hear people talk to you about losing money in forex and in trading. I don't want to say forex, let me say in trading, because notice how I didn't really say forex this whole video. Because it doesn't really matter what asset you guys trade. It's all the same. But you see in trading why you hear stats where 74 to 90% of traders lose money in the markets is because they do not understand this concept. They don't understand that trends don't end overnight. They are stuck on the wrong side of the market. And yes, long they do oftentimes win that trade because it will go in their direction. But one thing that they don't understand is that it is playing into their emotions more than it's actually playing into their understanding of why price is doing that, because they don't understand that price wants to go higher, but they are forcing the shorts because they see a 1 hour breakdown and that breakdown looks really big. So then they think it's time to short, when in fact they should either be sitting out of that market, or they should actually find proper context, or they should really be going long. But overall, in order for you to even execute trades on a market, you have to understand context, you know. And what was I going to show you now? So this was actually a trade I took last week Friday. So this wasn't today. This was all of those trades before. This was all today. But this was last week Friday. So as you can see, the same thing, right? On gold again. Could do the same thing on other markets, right? Again, I entered around 1991. My stop loss was 89, 1989. So that's $2 down there. Again, I'm risking $2 to make $6. I think there's 3 positions on this trade again. So I was risking, again, $6 to make $18. So that's just how much I was doing. And guess what happened? It went in my direction. And guess where I put the stop loss? As you can see right there, it moved up $2 away from the price at which I had entered. And that's when I put break even, and that's when I secure, and that's when I mitigate the risk. So if the price had to come down, it would come down and take me out of the market, because again, it could come down and it could carry on going down, and you do not want to be in a situation where you're going to lose money because you don't have risk management. It happens, okay? Not every single time the trades that you execute are going to be in the direction that you are, you're intending it for it to go. Your job is to manage it. Your job is to get yourself out of hot water and to get yourself out of a losing trade as quick as possible, provided that it's in a system. And guess what happened to this trade? You wouldn't believe what actually happened to this trade. I think this is the end of the slideshow. Guess what happened to that trade? I'll tell you what happened to that trade. It actually came down and it actually hit me out at break even. So it didn't carry on going up. It took me out, as you saw right there. As you can see, open trades closed for gold due to stop loss. And that was the trades that I was talking about there. It took me out the market, because that is part of trading. It is you're gonna have some trades where it'll hit break even. You're gonna have some trades where it'll hit the stop loss. You're gonna have some trades where it won't reach your full target. It is about managing it. It's about understanding that this is what you need to do. You have a system. Your rules are going to make you profitable long term, not trading. You could trade and get involved in the markets every single day. That does not mean that you'll make money. Sometimes you're gonna have to know, or you're gonna know when you have to stay away from the markets. It's gonna happen. It's your rules that will make you money. It's not trading. And I actually remember on the Friday, it didn't actually go past 1993 that day. It just continued going down and down and down and down and down and down. I mean, heck, you guys even saw that the price on the slideshows that I showed you here was literally around what, like the 1988. So it definitely went down on Friday. In fact, why don't I just open a chart and actually just show you? It definitely went down on Friday. Like, that was Friday. No, I don't want a Black Friday special. It definitely went down that day. That was a Friday, right? So this was Monday. So this was around that day. So on Fridays, it did not go past 1993. It went all the way down to 1973. So I probably would have lost money if I didn't have a stop loss, or if I didn't have any sort of risk management. I definitely probably would have blown the account. I would have lost all my capital in my trading account if I didn't have a stop loss, and if I didn't have a suitable risk management style, or I didn't have rules in place to say to myself that if my trade doesn't go in my direction, how am I going to exit out of a failing trade? And that's why people lose money, because they don't have a system, they don't follow rules, they don't have rules. And that's exactly why people will tell you that trading is a scam. That's why people will tell you trading is all this. No, people just don't actually sit down and do what I'm doing to you. Make a crappy PowerPoint and take some crappy, screenshots on his crappy iPhone 8 phone that was bought in 2019. I still have to get a new phone, and just sit down and just talk to you purely about what I do and you know, what traders do. Or let me say what I do. Most traders don't trade like how I do. Most traders will probably say I'm talking bollocks. But at the end of the day, I just would like to show you guys the actual side of it and what I do. And hopefully this makes sense to you. So yeah, if you got this far, thank you. I'm probably going to make another video explaining to you about context, because I think that's probably one of the things that I will keep doing and doing and doing. But yeah, that's basically what I do. So yeah.